The budget had quite a few things which stood out. One, fiscal prudence. The Honorable Finance Minister has kept the fiscal deficit down to 4.9% of the GDP, with an indicated glide path of 4.5% next year, which is a positive, especially in an era where fiscal prudence and consolidation seem to be more an exception than the norm. Second, the commitment towards growth came out very strongly, with the outlay numbers indicating a continued thrust both on the much needed investment in infrastructure, but also a renewed push towards skill development and employment generation. And lastly, on the tax front, while the budget speech saw quite a few announcements on the customs duty, what hit headlines were the changes proposed in the capital gains regime. An increase in the capital gains tax rates, very marginal for long-term gains from 10 to 12.5%, slightly higher for the short-term gains, 15 to 20%. But protection was provided for small investors. This was accompanied by a more strategic simplification of the capital gains regime by unifying the qualifying holding periods to essentially 12 months and 24 months. A positive indeed. Other positive changes included the announcement of the entire tax code simplification within 6 months, lowering of tax rates for foreign companies, rationalization of provisions for charities, and on withholding tax rates, removing all of the unilateral equalization levy, and more.